Welcome back to the Modi Sweep, the Chris Wood exclusive. Chris, we spoke about a lot of sectors, but let me come to the global piece now before I ask you the global questions. IT and pharma stocks don't form a part of a portfolio. What are your thoughts on these sectors?
No, they're fine, but they're not. I've only got 25 stocks in Asia, so they're not my preferred area to be. There's issues in terms of potential these stocks look comparatively cheap. There's issues of potential policy action coming out of Washington, which could potentially affect these areas, and we just have to wait and see what the concrete proposals of the Trump administration are. Clearly, there's been a lot of noise about this. There's been a lot of noise about this potential border adjustment tax. But there's a lot of noise, but there's a lack of concrete details. So I think we just have to hold off till we see the detail, assuming that at some point the detail is announced, which is not the case up till today.
Chris, let's talk about the next big event, the FOMC decision. We're just talking to Adrian Mowat from JP Morgan, and he pointed out that last time when we had big rate hike cycles from Fed, emerging markets actually had their best rally. Do you see something similar play out? And also your view on what the US bond market is indicating?
Well, obviously the markets are assuming now a rate hike this week. I think last Friday's US wage data was sufficiently positive to make a rate cut all but inevitable, given the speeches made by the Fed governors. But I think we need to recognize that the reason why monetary tightening expectations have picked up so significantly in recent weeks is not because the US data has become dramatically better. What's changed is the language of the Fed. So the Fed's more hawkish language seems to have coincided almost to the day with Donald Trump entering the White House. So I think that political reality needs to be understood. In my view, the US bond market is a key area to watch. We had a bond riot triggered by Donald Trump's election. We have some very aggressive stimulus policies being talked about. If it looks like these policies are actually going to be implemented, then my base case is that we would get another sell-off in the bond market and a potential testing of 3% on the US 10-year Treasury yield. However, if the market starts to get the sense that these policies are not going to be implemented anytime soon, then in my view the risk is that the bond market rallies, because in my view the trigger for the bond market sell-off we saw after Donald Trump's election was expectations of policies being implemented, highly reflationary policies. If for whatever reason the market starts to think these policies won't be implemented or be significantly delayed, then I think this whole cyclical reflation trade becomes very vulnerable.
But what's your own base case? Do you think the markets will go past, it's already at 2.61, the 10-year bond yields. Do they breach that 2.64 high set a few weeks back and go on towards 3? Is 3 your base case, or is peaking off at 2.64 your base case?
My view, my view is simply, do we get the policy or not? If we get clarity on the policy, I think we get another bond sell-off. If this policy is not forthcoming if we don't see any clarity on the policy in the next 2 months, let's say the Obama administration gets bogged down, the Trump administration gets bogged down dealing with Obamacare, nothing happens on tax reform, and personally I think the bond market's more likely to rally. I think it's much less about the US data and much more about what policies are announced or not announced. The US economy today is not that strong.
Well, actually,
so it's all about whether these expectations of tax cuts happen.
Okay. Well, sorry to interrupt you. I was reading your latest edition of Greed and Fear, and you have some question marks over the US growth pace itself. You point out that this is the first that systematically growth forecasts tend to get wound down by both the Fed and the US government. Are you unsure only about that piece? Generally, the global economy seems to be heading for a better year in 2017, as evidenced by, the Chinese growth, as evidenced by inflation, as evidenced by the rise in the Baltic freight rates, generally import data from ASEAN and Asian countries. Are you confident that global economy will grow better in 2017 vis-a-vis 2016?
No, the Chinese data has definitely improved. And I think there's definitely evidence of a pickup in global trade data. Korean exports are a good example. We believe a lot of this pickup in trade is connected with the increased purchasing power of commodity countries who have seen a pickup in commodity revenues because of the big rebound in commodity prices. Now, my point is simply that in terms of US real GDP growth, we haven't seen any pronounced pickup. In terms of the inflation data, a lot of this increase in inflationary-driven expectations is on the back of the commodity rally, but we are now seeing the peak year-on-year effects of that commodity rally because the oil price, I believe, bottomed in February last year. So all I'm saying is a lot of people are extrapolating things forward, and in my view, it's not so clear that everything's so much as strong as everybody seems to think. So fundamentally, my view is this whole cyclical optimism in the US, bond sell-off we saw late last year, is all based on the anticipation of highly stimulative policies in America, be it corporate tax cuts, be it a corporate tax amnesty to try and incentivize up to $2.5 trillion of cash sitting outside, corporate cash sitting outside America to return to America. It's predicated on potential focus on this much discussed border adjustment tax, on a change in the tax laws to allow 100% deduction of capex in America the year you spend it. So basically, for the bond market to really sell off and this cyclical trade to kick in, you've got to see policies that make markets believe there's going to be an investment cycle in America.
Okay. Chris,
even if it's at the expense of an investment cycle in the rest of the world.
Fair enough. Let me get back to India then, Chris. Equity market is about greed and fear, and I'm not saying that because, you know, we're talking to you. Last year, there was fear in the market. February, the Nifty was sub 7,000. In 1 year, do you think the meter has turned towards greed? What's the big risk for Indian market from here on? Do you think this market now runs away and at some point becomes so overvalued that you know, it falls under its own weight?
Yeah, well, that's probably a more likely. I think right now the shift has probably started to move towards greed since the announcement of this election result. But I think it's early days because, as I said at the beginning of the year, foreigners were looking for reasons to sell India. I can tell you that because I had meetings with many foreign investors. If you argued a positive story on Indian equities in January of this year, you got a lot of pushback from foreign investors. I would say that psychology had changed by 2 weeks ago, was the last time I talked to a lot of investors in Singapore. And at that time, the folk psychology was, well, it's gone up, but we hope this UP election result, which is unlikely to be a result in a big victory for the BJP, will lead to a pullback and weaken buy. So obviously that's now not happened. So there's now potential for foreigners to feel under pressure to be forced into the market.
Well, you know, in the past half hour, you've indicated to us at least 3 red flags. 1, US growth need not be as good as several observers are making it out to be. 2, Trump's tax policies and infrastructure spending is yet to be proven. And 3, that commodity countries which have led the risk-on trade globally, led the global trade higher, could see a peaking off. Now, if these 3 are true, would you say that the global risk-on trade is at risk?
Well, it's potentially at risk, but it doesn't get in. None of this detracts from my overweight in domestic demand India, because the great thing about domestic demand Indian stocks is they're not really geared into the commodity trade. They're not geared into expectations of Trump's tax reform, so therefore they're much more trading on their own merits. That's why domestic demand India remains a core holding.
Okay, one last question, Chris, and you know that this is something a lot of Indian investors want to know. Do you think we could have a rally in the longer term similar to what we had in the last bull market, 2003 to 2007? We haven't seen that kind of bull market. Do you think we could be at the cusp of a rally like that?
Well, no, logically that should happen sooner or later, but the one big missing link in this Indian equity story remains the lack of an investment cycle. So the big distinguishing feature from the current period, of the period of the Modi administration thus far, and what we saw between 2002 2009, in that period we saw a big investment cycle in India, and that's precisely what we don't see today. And that's where the failure or the lack of willingness to recap the Indian public sector banks more proactively is undoubtedly delaying the onset of a new investment cycle. So that remains the negative in the Indian story. But that macro negative creates a big growth opportunity for the private sector banks, precisely because the state-owned banks have got these overhangs of stressed assets.
Chris, it's always a pleasure listening to you. Thank you very much for joining us.